We get a lot of questions about what's gross profit, net profit, EBITDA, cash flow. We're gonna break it down for you line by line. So let's start from the top. First, we're gonna subtract our direct costs, our labor, our materials, or these are commonly known as COGS or the cost of goods sold. After we subtract our COGS, we have our gross profit. So think of gross profit as your profit per unit or per service done, not including all your overhead expenses. Next, take your gross profit and subtract all your general expenses, your rent, your salaries, your office supplies, everything that's gonna take to run the business. You also need to subtract your interest cost and your depreciation and amortization come into play here. And that brings you to your net profit. So that's your profit after all of your expenses. Now your net profits, also your net income, that's what's generally used to calculate your taxes. So for looking at businesses to buy, we want to normalize the income statement a little bit. So we're going to add back certain expenses that are really more specific to the owner at the time to get to what's called EBITDA. So earnings before interest, taxes, depreciation, and amortization. So to get to our EBITDA, we're going to take our earnings, our net income. We're going to add back our interest, our taxes, our depreciation, our amortization, and now we have our EBITDA. Now, if you're looking to buy a business, in this world, almost all the businesses are pass-throughs, you probably won't see a line for taxes. That's gonna show up on the owner's personal tax return. Then next, we take our EBITDA, we add back the owner's salary and any personal benefits they might receive. So if they have a car or a cell phone or anything like that, we're gonna add that back to the EBITDA, and that's gonna give us what on BizBuySell, they call the cash flow, or many websites call the cash flow. It can also be called the SDE or seller's discretionary earnings, or sometimes it's called the owner's benefit. And now this is the value that brokers advertise businesses for sale, because it's taking the earnings of the business, it's adding back all the expenses that are related to who owns the business. So we don't care about the seller's level of interest, we care about our interest payments. So let's take this one step further. So we're gonna take the advertised cash flow, SDE, or owner benefit, whatever you wanna call it, and we're going to add our expenses to the structure of the business. So we're going to take that cash flow, we're going to subtract what we think is a normal level of CapEx. So think of CapEx and depreciation as a similar thing. So depreciation is how CapEx shows on the tax return. We're going to take what we think is a normal level of CapEx. There's always a certain amount of spending you need to do in a business just to keep it up and going. After we subtract the CapEx, we're going to subtract our loan payment, which is going to include our interest expense. And then we're also going to subtract our tax rate, which we're going to have to go back through the income statement using our net income to figure out what our taxes paid are going to be. And then we can figure out our after tax, after loan payment cash flow. And now this is the money that actually makes it to your pocket.